Good morning, 10KSB alumni, and welcome to 10KSB Talks. I am Stephanie Bell, your Director of Alumni Engagement, and I am so excited to bring to you the fourth edition of 10KSB Talks, which is your source for monthly continued education as an alumni of the 10KSB Delgado program. This webinar series is an opportunity for you as 10,000 small businesses alumni to continue the learning that you started in your 13 weeks with us and deepen your understanding of subjects that affect you as small business owners. We are going to give you the opportunity to ask questions live to our presenter today. Feel free to type your questions in the chat box as we go through the presentation, and at the end I will be sure to read them aloud. All 10KSB Talks are brought to you by your fellow alumni. So for us, this is an opportunity to showcase a thought leader amongst our network. Today, we're lucky to have Tom Daly. He's the principal and owner of Benefits Administration Group joining us. Tom eats, sleeps, and breathes employee benefits. He knows firsthand what employers want. As a former president of the Society for Human Resource Management, Tom has a handle on all the issues, pressure points, and frustrations that his clients live with. More than 23 years of experience in the business, Tom never stops trying to make it better. The constant changes in the economy and shifts in employee benefits preferences fuel his search for new strategies and solutions to individual and employer needs. Tom created Benefits Administration Group in 2012 in response to the complexities of health reform and a shifting benefits landscape that challenges human resource professionals to cut costs and not benefits. He's marshaled just about every tool and resource imaginable to help clients through the balancing act of managing benefits costs, accommodating PPACA provisions, and dealing with employee uncertainty. It helps that Tom's hand-picked team of consultants are longtime colleagues who provide depth in HR and benefits technology, wellness, flex plan administration, HRIS, advocacy, compliance, enrollment communication, and benefits administration. Today, the Benefits Administration Group serves about 100 employer clients and is licensed in almost every state. Welcome, Tom. We're really excited to have you. We had a lot of inquiries into this 10KSB talk once it was advertised. Particularly, people were interested in whether or not they would fall into the small business category that you were going to talk about today. I know many industries categorize small businesses different. What do you consider a small business?
Well, thank you very much, Stephanie, for putting all this together and organizing it. And that is a great first question to start because we do all sort of define small businesses differently. For this particular talk today, I'm focusing on kind of the Affordable Care Act definition of a small employer, which is going to be at 50 full-time equivalents or full-time employees equivalents or fewer. So that's kind of how we're going to define small businesses for the purposes of this discussion, but I'm going to cover a lot of ground here today. I do encourage everybody to ask questions. I know we're in a little bit of a landmine of change right now, and I know people have questions because we get a ton of them every day. I'm going to attempt to try to encapsulate some of this stuff for you guys and give you some thoughts about how to move forward. For me, I was part of the small business, the 10KSB in the cohort 8, so I did that, finished up in 2014, kind of in the midst of a lot of change that we had going on. But just to kind of go through the what we're going to be talking about today, I am going to give a little bit of a brief history of employer health insurance just in general, some trends in offering health benefits, factors that cause those trends, to get into a little bit about alternatives to group coverage, where people are getting their coverage now, the now and the future of health insurance as best as I can see that, given the change that we have going on right now, and then just some practical things about what you should be doing now, what I'm doing as a small business owner to try to help myself and my employees, and then what I would recommend you do as well. So to jump right in, where did this roller coaster begin? Like from a macro sense, how did employers get in the middle of providing insurance in the first place? That's a question that's been posed a lot, and it's going to become a more pertinent conversation as we move forward, because the whole concept of employer deductibility of their contributions towards employee health insurance is being debated right now. All of the different alternates, replacement plans that exist for the Affordable Care Act do start touching on this. So how did employers get in the game of providing insurance to employees? Well, that goes back, believe it or not, to the 40s, where when the war was going on, there were some price and wage controls that were thrown down, but at the same time, they issued a pass to employers or to deduct the portions that they contribute to their employees' health insurance. Well, when you have frozen wages and then this new tax advantage vehicle that exists, that's what drove a lot of the businesses to get into the game of providing insurance to their employees. If you look at just how people get their insurance today, this is kind of what it looks like. This is from a 2016 slide, so this is not even a year old. But we got 323 million people in the U.S. Just a little under half of them get their insurance, their health insurance care from their employer. Medicare is going to be for your over 65 folks. Medicaid and CHIP are going to be for folks that qualify based on income levels. There's been some change, obviously, to Medicaid with the Medicaid expansion as part of the Affordable Care Act. Here they're talking about the Affordable Care Act, specifically individual policies in the Affordable Care Act. This would represent your subsidized coverage as of last year, and then the balance is going to be from individual policies. But they're still looking at about 29 million uninsured people now, and that's sliced and diced a bunch of different ways. There's some people that are eligible for other coverages in that mix, et cetera. But employers are kind of in the driver's seat for providing health insurance to their employees, but employers is kind of a big category. If you look at the size of firms and their approach to providing health insurance, it tells a much different story. This breaks down companies that have 3 to 49 workers, 50 to 99 workers, and 100 or more. So, and there could be a subset even there, even further if you go 3 to 20 employees, 20 to 49. Firms that have more than 100 employees have historically always from the advent of employers being in the game of offering health insurance, they've pretty consistently provided access to health insurance to all their employees. 99%, 97%, 95%, kind of 94% on the low end. But that's largely the majority of 100-plus life groups. 50 to 99 workers, it's still pretty strong, though there's a little bit more fluctuation going on here in the 50 to 99 worker category. And then if you get into 30 to 49, you see that's the lower line here, and that's where there's been a heck of a lot more gyrations. If you were to go down into the 3 to 20 and break this up even further, you'd see that probably in the 30 to 40% range as far as employers participating in coverage. This, believe it or not, is a lot of what inspired me to just have this conversation, because this is some pretty wild gyrations that are going on right now, and I'm personally seeing some even stronger gyrations in employers getting into and out of the group insurance market, particularly in the small employer level. And I have my thoughts as to what's driving that that I'm going to go ahead and try to share with you guys as well. But this is some significant fluctuation. I think if you look at it just kind of from a timeline standpoint, the Affordable Care Act was passed in 2010. So it was being discussed leading up to 2010. That's where we see a little bit of a spike in the small employers getting into the game. I think this is a function of just a lot of people talking about it, a lot of people talking about providing coverage. We had that sort of false start with the healthcare.gov rollout that was a little dicey, and then employer coverage has fallen off since then, and then now started to pick up again. I think you're going to see this 2016 number go up fairly significantly, and I think 2017 will be up even higher based on a couple of things that I'll get into in a second. But that's kind of the breakdown of why employers are in the mix. And people ask me, are employers going to ever be pulled away from providing insurance? And that's something I ponder on a pretty regular basis, because they sort of backed into being in this game in the first place as employers. But employers also are the tax collectors for the federal government largely. They withhold and remit taxes on behalf of employees, and a lot of the problems that we've seen happen in the individual market are a function of them having their own decision about whether they're going to participate or not participate, continue or not continue, and some of the games that get played with that. And if you look at insurance as a tax, which, John Roberts, the fifth vote to kind of approve the Affordable Care Act back in these days when it was being debated over the constitutionality of the Affordable Care Act, did determine that the reason that the government could be involved in mandating individuals to provide or to carry health insurance coverage is because of the taxation power of the government. So if we're talking about insurance as a tax, then employers are probably not going to be able to not be involved because they are the tax collector for the federal government. That's just a thought, but I think it's kind of borne out a little bit. But so how did we get to where we are right now with some of these gyrations? Obviously, the Affordable Care Act had and is continuing to have enormous impact on particularly the small group insurance market, because if you think about it, a small employer, somebody that like myself who has 7 employees, the alternative to providing group insurance is going to be individual coverage. If I and my employees had individual policies in place and were happy and content and never said a word about it, I probably wouldn't rock that boat. And most of the employers that I talk to and see, I can almost track to the day that they started offering group insurance, and it's mostly because they have a key employee or themselves that need coverage, and they start looking around at their alternatives, and group insurance becomes an alternative that they consider and maybe go with. But it's largely kind of pushed by either an employee, a key employee, family member, or business owner needing access to coverage themselves. And the Affordable Care Act changed small group insurance in a significant way. Before the Affordable Care Act, small group insurance had medical underwriting associated with it. So when I would go to when I would have a 5, 10, 20 person employer group ask me for insurance quotes, I would get some demographic information back from them, their dates of birth, their home zip codes, their genders, etc. And then I'd go and run quotes from all the different carriers. And then I would get what they call non-medically underwritten quotes or base rate quotes back from the insurance companies. I'd present those to the small employer. And then if the employer wanted to go ahead and pull the trigger and put that plan in place, I would then need to go to each and every one of their individual employees, ask them medical questions, and those medical questions would go to form a factor that would now be applied to that base premium. So as an example, a 1.0 would keep the quote that I quoted the same, a 1.5 would increase it by 50%, a 2.0 would double it, etc. Well, if you think about that logistically, that's messy. I get demographic information from a prospective, interested small employer client. I run numbers, I present it to their employees. They kind of come up with some idea of ballpark cost shares that they'll do. And then I take it back to the shop. We look over the medical questions, and all of a sudden those rates go up by 50% or 20% or 100%. And then that may blow up right at that moment. That small employer might say, you know what, I wanted it at the base rates, but now neither me nor my employees want it at these higher rates. And that was a reality of how small groups have purchased their health insurance before the Affordable Care Act. So the Affordable Care Act changed the small group market by basically not allowing small employers under 50 employees to medically rate their individual participants. In addition to that, it kind of standardized the pricing of the plans that exist in the small group marketplace. It consolidated the number of plans in the small group marketplace. And I'm going to jump to a couple of web pages kind of from this slide just to show you like personal situations and how kind of my situation has evolved in the individual market and the individual market pricing. But that entered the plan, and so that standardization of pricing meant that individuals that were 25 had a different price than individuals that were 26, 27, 28, 29 per individual age banded rates on a yearly basis entered into the small group market. So that was pretty fundamentally different than what it would be before. Positives and negatives to that, but on the positive side, I didn't get my plan pricing changing from the time that I presented it to the time that they decided to purchase it. Negatives of it were I had, if I was talking to 10 people in an employee population and I had a 25 and a 60-year-old there, their pricing would be 3 times, there would be a 3 times difference between them, meaning if the 25-year-old was paying $200, the 60-year-old would be priced at 3 times that, or $600 for the same exact coverage. So some problems went away, and then new problems kind of came to the fold. Just to kind of show you on a couple of things that I pulled up, this is what I did. This is a little fun trip down memory lane for me. I blog pretty regularly, and I had written a blog post back in 2009. This is when the heat of the healthcare debate was happening, just to try to see what the impact of healthcare reform would be for me and my family. So what I did was, at the time, I was splitting time between New Orleans and Austin, Texas. So I basically took my family, which at the time was me, my wife, and 2 children, and I ran Blue Cross plan rates for me and my family in Austin, in New Orleans, and in Connecticut, in Massachusetts, excuse me. And I ran those rates, and I put a little comparison together. And this is just how I compare for my group clients, for my individual clients, et cetera. I just kind of put some common comparison points, and then I put them side by side to help me decide. Well, when I put all this stuff side by side, I saw, some minor coverage differences, but some pretty major price differences between myself and my family in Austin, New Orleans, and Boston. Some other things that I thought were interesting that came from this. All these plans were from Blue Cross, as I said, but there was only 16 plans to choose from Blue Cross in Boston. They ranged from just under $800 to about $1,900, and this compared to over 100 plan options in Austin or New Orleans. This is just from Blue Cross we're talking about, ranging in cost from $138 to $1,296. So my little summation from that was that, Massachusetts, that was obvious, the model for the Affordable Care Act, Massachusetts health reform produced higher prices and fewer choices for me. That was my little takeaway. So that was back in 2009. 4 years later, I do the same kind of pricing experiment for myself. Now I had another child in there too, so I'm now 42. My wife's 39. I got a 10, 8, and a 2-year-old, and then when I look at it, I go for a little bit of a broader approach. So now at this moment in time, we had healthcare.gov was up or coming online just a couple of months later than this. We had the Commonwealth Connector where I could run and run options as well. But so in this scenario, in Austin, my family and I had 212 health plans to choose from. Low was $286, high was $2148. In New Orleans, I had 147 plans to choose from, ranging from $182 to $1813. And in Boston, I had 66 plans to choose from, ranging from $890 to $2530. So again, it feel like I kind of went further, 4 years more down the road, but it amounted to, when I looked outside of just the Blue Cross family of carriers, an even more significant kind of shrinking of options. Now, if I go into today, this is me, my wife, my 3 children today, and this is just our little quote engine that we use. We have a household size of 5, and I put a big number there for household income just so that I wouldn't show any subsidies. I'm going to show subsidy calculations in a section, but so I wouldn't show any subsidies. Now I have, in Louisiana, I have 21 plans to choose from. So I had over 100, now 147, now I'm down to 21 in a couple of years. The lowest cost option for me starts at $1,000. The highest cost option for me is almost $3,000 a month for my family. And this isn't, this isn't everything free kind of coverage for my highest option here. This is me having an $1,800 per person deductible, no office visit copays, no specialist copays. I'm paying negotiated rates until I hit an $1,800 per person deductible. So that's not anywhere near what I remembered from back in these days, where I had office visit copays and prescription drug copays, etc. So the world has changed quite a bit. Why I'm bringing all this stuff up now is because the small group market, or the small group market, is impacted significantly by the individual market. And the small group market as the primary alternative to the individual, or the small group market is the alternative to individual plans. It's had to have that kind of an effect. To kind of look at things a little bit further, the Affordable Care Act introduced more than just taking away of medical underwriting and subsidies. It also expanded Medicaid, and that's something that people have had to kind of get their heads around here. So I tried to do a little analysis here of how income impacts cost and net cost. And so in this example here, I use a 40-year-old with 2 children under 18 and what they can expect to pay at various income levels. So at $25,000 a year in income, they don't qualify for any kind of subsidy because the entire family qualifies for Medicaid. So they have no cost, essentially. At $35,000, the children now are the only ones that qualify for Medicaid, but the individual qualifies for a subsidy for her coverage of $180 a month. Going up that income ladder at $45,000, the children still qualify for Medicaid, but her subsidy drops from $180 to $59, giving her a net cost of $332. At $55,000, she's no longer eligible for Medicaid for herself or for her kids, but she's still eligible for a subsidy for the family now. The subsidy is now at $254, giving her a net cost of $525. And if I go up the ladder, you see the subsidies coming down further and further, and you hit $85,000, and a family of 3, like this one, no longer qualifies for any help on that $779 a month premium. So this one simple example of a 40-year-old with 2 children under 18 can pay nothing or $779 a month for their care. And this is how that care kind of evolves and changes as those income levels change. So that's something that most employers have really, Medicaid, historically, before the expansion of Medicaid, if you were working, you largely didn't qualify for Medicaid because even minimum wage would kick you out of Medicaid eligibility. Now you might qualify for CHIP for your children, the Children's Health Insurance Plan, but you wouldn't qualify for yourself. So employers have some knowledge of Medicaid with respect to CHIP, but really nothing with respect to their working employees. And now they have this situation where actually their working employees may be Medicaid eligible. They may be subsidy eligible. There's a good chance they're subsidy eligible. So the employers need to know how what they do with respect to group health insurance impacts this calculation as well. A new wrinkle that we've seen this particular, it was actually last year is when it started, and it's just accelerated this year, is the cost difference between individual coverage and group coverage and how that's evolved over the last number of years. It used to be a coin flip. It used to be if you get a small group plan or you get an individual plan, it's kind of 6 one, half dozen the other. No real major change in pricing between them. Now we're seeing as much as a 30, sometimes 40% premium difference between just the base underlying cost of group insurance versus individual insurance. And because now the plans are rated on an individual age basis, and the rates for small groups are standard shelf rates, just like the rates for individual plans are standard rates for rates, we can pull these things up in October, November, and know for the entire year of 2017, unless there's some kind of filed rate change, what that difference is. And this is the kind of thing that we're looking at right now. This is comparing individual plans from Blue Cross to group plans from Blue Cross. And if you look at the players in the group in the individual insurance market, we're down to basically Blue Cross is Blue Cross and HMO Louisiana. That represents 14 of the 21 plans available. Humana offers 2, and Vantage offers 5. Vantage is a company out of North Louisiana that is not a national player. They do exist, and they only exist in the individual market space. So that there's not a tremendous amount of players in there that are providing coverage, and this is what we're looking at right now. So that was a fair way for me to kind of compare the two. So, what's happening today and what will happen tomorrow? Well, I tell you what, in 2014, when I was going through my my Goldman Sachs program, and I was in the deep, cave of planning and thinking and pondering my business, one thing I didn't ponder, we were 3-4 years into the Affordable Care Act, but I did not see a President Trump coming. I didn't see that even really being discussed, to be honest. And so we've had 18 months to a year now of politicking around this, and now an election. And since we've even started practicing this presentation, we have executive orders flying around at a pretty rapid pace that are impacting a lot of things. Some things that I thought were worth mentioning that have significantly changed as the employer and individual market were kind of shuffling around in 2010 through 2014-15. There was a big thought process from small employers in particular that, what, I need to get out of the group insurance business because my employees have these expanded Medicaids, they have these subsidies. I really shouldn't be in this game anymore. And so they had some people that say, what, I'm getting out of it, but I'm going to provide some dollars for my employees to go out and purchase insurance. Well, the way that those employers were providing those dollars was in things called health reimbursement arrangements. Well, in the divine wisdom of the federal government, health reimbursement arrangements were captured up in the whole Affordable Care Act legislation and definitions, and because they had capped benefits by the nature of them, and the Affordable Care Act plan made it to where group coverage could not be capped. Essentially, HRAs were deemed kind of a non-tool for employers to use. So employers that had been doing this, putting dollars into a bucket and allowing employees to use those dollars pre-tax to purchase individual plans, all of a sudden couldn't do that anymore. Now, believe it or not, that's kind of come full circle again, and there's been legislation passed that allows employers to use dollars on a tax-advantaged way to provide to their employees so that their employees can go out and purchase individual plans. Unfortunately, it came about after the individual market kind of imploded, the way I described a little while ago. And the pricing on the individual market is so unattractive that even though that concept is appealing for an employer to do, it's when you get down to it and you start running numbers, it becomes not the best decision for employees. So that's happened since we decided to do this presentation, this whole HRA legislation. And now, after that, we had, again, the executive order, which we're all sitting around trying to understand as, removing the burden of the Affordable Care Act on employers and individuals and purchasers of insurance. That could be interpreted to mean that the individual mandate might go away and the employer mandate might go away. That also means that reporting requirements might go away. That might mean, there's a whole lot that could mean, and we're all trying to figure out what it could be. I was one of the crazy people that was reading the 2,700 pages of Affordable Care Act legislation, and I'm now back in the game reading replacement bills, and there's a few kind of bouncing around out there that exist that are all taking different approaches to doing this. If you're really kind of interested in sort of looking at this and digging in, and I don't even know if I recommend it, to be honest, because I tend to have more questions when I'm finished reading these things than answers, and I think that's by the nature of them. But Tom Price is going to be the new HHS secretary unless he does not survive the confirmation hearings. But he's somebody who's a surgeon from Georgia. He's also tried to put up a replacement bill at least 3 separate occasions. I've read his bill extensively, and there's some interesting thoughts that kind of weave their way through that bill, including capping out how much an employer can contribute to pre-tax employer plans. I mentioned to y'all earlier that that's being openly discussed. It's also being discussed in one of, Cassidy, our state legislator here in Louisiana, has 2 different bills that he's co-sponsored. One he did with Jeff Sessions that has a lot of those same kind of tenets and expanding HSAs and the crossing state lines, the buzzwords that you hear on all the talk shows. But he also has another one that I think it actually just passed, that I don't know if it's going to go anywhere from here, but on a state-by-state basis, it allows states to decide whether they're going to keep all or part of the Affordable Care Act or scrap it and start with something else, which is an amazing thought to even kind of try to wrap your head around conceptually, because if I thought we had sort of a mess to clean up right now, to have 50 different versions of messes seems sort of difficult, but it also seems very political as far as its approach, trying to keep everybody happy. So what will happen with that? I can say right now, the best defense for all these things, I can't be definitive. I know in 2017 we're going to have this big difference between the cost of group and individual insurance. So if you're individually covered and insured and you haven't priced group in a while, that's probably worth doing. I could say that definitively, just because I've personally experienced what that difference is for myself and a number of clients. But I would also say, just to keep your eyes and your ears open as much as you have the stomach for, to additional changes that are coming down the road. If you have group insurance in place already, you have to shop it at least once a year. You get an annual renewal, but you should really probably shop it if you have demographic changes as well. You open an office in a different physical location. You start hiring an atypical age group of people. You should think about how you classify your employees and determine budgets according to that, because this concept of defining a contribution to healthcare versus defining the benefit of healthcare is something that will take hold, similarly to the way it did in the pension world. Defined benefit plans transitioned to defined contribution plans like 401ks. I think that same thing's happening in the insurance world as well, where employers aren't saying I pay this percentage or this, I give you this insurance. They say I give you these dollars, and these dollars are used to purchase insurance. So I did mention what you should do right now. I think that, like I said, shopping at every opportunity is a really good idea. Being mindful of how things are changing underfoot, meaning additional expansions or contractions of Medicaid, medical underwriting changes. If there's a wholesale repeal of Obamacare without a replacement in place, I don't think that's an overnight change in the marketplace, because these markets, these insurance carriers, still need to file products in the states, and there's a little lead time that they need to do this. So they're effectively kind of operational as they exist today for 2017. They can start making moves to change for 2018, but that's when that change would come into effect. I would, again, like I said, price alternatives, understand demographic shifts, and understand your employees and how they are different within your organization, and how you can budget accordingly for that. So we kind of hit some high-level overviews here. I took y'all in a couple of different directions here. Does anybody have any questions specific to either what they're going through or what they're hearing, or what they think they should be doing going forward?
Thank you, Tom. That was fantastic presentation. I know it's really inspired all of us to start thinking about ways to prepare for what's to come with the new administration. Yes, I think it's a great time to turn it over to our attendees for questions at this time. Please use the chat box to type your questions, and I'll read them aloud. I do have a couple questions in queue. I'll start with the first one. What are your clients doing in regards to their small group coverage? What are you seeing?
I'd say, yeah, right now there's nothing sacred, to be honest. I mean, the employers that have group coverage are looking at all kinds of alternatives. They're looking at partial self-funding options, even at small employer groups. They're looking at health reimbursement arrangements, which are that whole idea of defined contribution, just putting some dollars out there and letting people buy individual plans. They're looking at individual plans with subsidies. They're looking at subsidizing deductibles, because the deductibles and out-of-pocket maximums are, have gone pretty crazy as far as the levels that they've reached for the last few years. And I don't think, like I said, I don't think anything's sacred anymore. I think there's a general desire, and I'm with people from this respect. I mean, I'm run my business. My business just happens to be in the employee benefits business, but I run my business, and I really need to focus on running that business every day. I'm sure everybody that's on this call and that runs a small business themselves needs to put all they have and more into keeping their own business going and afloat. And they don't feel like, wow, today's the day where I have an extra, half an hour to think about all the different ways I could potentially structure a benefit plan or cover myself, etc. However, there are people like myself and hundreds and hundreds of others out there. We're licensed insurance agents, so we don't charge employers money to look at options for them. We're paid effectively by the insurance companies whose products an employer ultimately ends up buying, if they end up buying a product. So my point of saying that is not to try to solicit anybody, but to try to say there's a mechanism in place for people to be compensated to help you with these kinds of things, to help you through these kinds of thoughts and decisions. And somebody like me or people that do what I do for a living, we can get just a little bit of information from somebody, and we can go off on the go off and look at everything and then bring it back in a format that will give you the ability to just in 15 minutes or so say, okay, now I know where things are. I'm going to do this, this, or this. So I think if it was something like where people felt like, oh man, I have to do this on my own, I really shouldn't do it, I could see how most people would just move on to the next thing, and there's plenty of things to move on to. But I think it's worth it to have somebody that you know and trust, that is independent, that has relationships with a lot of these insurance carriers, and can go to market for you and bring back options for you without you having to stop what you're doing, other than the sharing of information on the front end and then the digesting of that summary information after the fact. At the end of the day, you might choose to do nothing. But I know for me, whether it's anything, my AT&T wireless bill, my Cox bill, I don't know whether I have a good deal or a bad deal until I kind of price my alternatives. And that is a pain for me to go and shop those things. I wish there was an agent of some kind I could go to shop my my wireless service and my internet connections and all this other stuff. But I feel like I'm kind of out doing that on my own, whereas this industry does at least have a mechanism in place to to provide for assistance.
Great.
So I hope that's what you're thinking of.
Yeah, absolutely. So you touched on the executive orders a little bit, but what will happen with the President's new Affordable Care Act executive order? What can we expect?
That is boy, the term expect or predict and the President haven't really gone very well for me hand in hand these days. I think globally we can expect a president that's kind of broad brush strokes, more business friendly, more sensitive to the regulations and things that are imposed upon businesses. But the devil's in the detail of Affordable Care Act changes. That's why I've been trying to read some of these replacement bills as best I can, and quite honestly, why I've been a little bit disappointed in what I've read, because they tend to paint the broad brush strokes, and there's not the details. And when we get into the details is where it really is impactful for people. So like I said, Tom Price, the Secretary of HHS, is an extremely powerful position as the law is currently written. The Affordable Care Act, the way it's written, I think in that 2,700 pages of law, the term "the Secretary shall determine" is written in there probably 500 times. So the Secretary of HHS, which soon Burwell was Burwell, now going to be Tom Price, is an enormously powerful person in there. So that person has the ability to kind of take, the law at the high level and then go to how am I going to implement it. And small businesses aren't impacted by things like 1095 reporting and some of the stuff that we see at the large employer side, but those things came from, the Secretary. So I think we have a much more, business-friendly, less regulatory burden sensitive administration coming on. I don't think we can deny that one way or another. And I think beyond that, I think that just, to me, makes it even more important to go out and test markets, because I think, if these carriers, these insurance carriers that had their portfolio of offerings on the individual side cut from hundreds down to a few, they had similar things happen on the group, but not to as great an extent. But if they're unleashed, then there could be a flood of new options entering the marketplace, and it's going to be incumbent upon all of us to figure out whether there's anything to those options. Some of the reasons that push the pricing the way it is a lot of mandates that are included. If some of those mandates go away, well then, yes, there's fewer protections for the individual insureds under there, but if that protection was for contraceptive services and things like that, and I'm a man, then maybe I can choose to not buy something that I don't feel like I need. Do they go back to male-female pricing? That was one of the Affordable Care Act changes, was that men and women are priced exactly the same, and there's no more distinction on price. Well, that was good news for women and bad news for men generally, especially in childbearing ages. That averaging really hurt young men, young healthy men. It really hurt because they previously had much less expensive options. So, if some of those restrictions that put us in this position go away, then to me, the idea of going to market and going to figure out, okay, well now, given this, what do I do now, I think is even more important. And you have to be a good consumer. There's non-compliant markets that exist today, even in the wave of the Affordable Care Act. There's plans that provide coverage, but not Affordable Care Act compliant coverage, that are being sold in the marketplace right now. Now they have all kinds of disclaimers on them, and hopefully if the agents that sell those products are doing what they're supposed to, they're informing people of that. There's also a lot of faith-based sharing programs, medical sharing programs that have kind of cropped up in the last few years, and I'm somebody who's faithful and a member of a church as well, and I would love for that to be the solution to things, but those are essentially buckets of money that the contributors put into, and they're sort of a promise to pay when and if you need it, without a lot of contractual obligations. And unfortunately, if I'm having to go in for some big, crazy, expensive procedure, that wouldn't satisfy the physician as a form of payment, or the hospital, or anything like that. They do coach you through applying for religious exemptions to get out of penalties and things like that, but at the end of the day, that's just something that I couldn't get 100% comfortable with personally. Certainly not something I could professionally recommend, unfortunately, but there's people that are going that route as well. So, I think that, the executive, I guess if I'm looking in my little microcosm of healthcare and health insurance, and the reprieve I take on like major changes like not happening is that there seems to be executive orders covering like 20, 30 different big topics right now too, that all seem to be equally complicated and challenging. So, I don't know if this is not something that can be wholesale changed by executive order. It does need to go through the congressional mechanisms that exist. That means the House and the Senate, and that is going to require probably compromise off of what's there already. Like I said, I think the best advice is to just try to, like I said, find somebody that is vested in this, that is keeping an eye on it, and then from time to time, ask them to kind of see what your situation is and how it's changed given the new lay of the land. And I mean, I'm just being 100% honest about that. It might sound super self-serving as somebody who actually does that, but it doesn't have to be me, but it should be somebody. It should be somebody that is in the business professionally, has access to a bunch of different carriers, and can kind of educate you along the way. I see a question posted here on what's the difference between an HSA and an HRA. Both
Tom,
of those are, I'm sorry.
it's okay. It's actually a two-part question. So what is the difference between an HSA and HRA, and also who would administer those to small businesses, a payroll company or a company like yours?
Okay. Well, HSAs are generally held by depository institutions like banks. HSA stands for a health savings account. That actually is a physical bank account. And from an administration part, there's really not a whole lot of administration that goes into an HSA. It is money in, money out. You as an individual who has an HSA have some rules that you have to play by in order to have them, and you could pay the price on your taxes for not playing with them properly. But essentially, if you have a qualified high deductible plan, you're eligible to open a health savings account and fund a health savings account up to the IRS maximums on an annual basis. You can use that money in those accounts to pay for any of the 213D IRS code eligible expenses. So all your deductibles, co-insurances, co-payments, all that stuff, out-of-pocket costs associated with vision, hearing as well, all are going to be eligible expenses paid, and you can roll over your funds from year to year. A health reimbursement arrangement is actually not a bank account. It's actually like a record-kept account, sort of like a flexible spending account. Is not a physical bank account that money is put into. It's an account that's record-kept. So a health reimbursement arrangement is a mechanism by which an employer can fund employees either deductibles, co-insurances, co-pays, so out-of-pocket expenses related to health care, or now it's able to fund individual health insurance premiums as well, according to that new change that happened. So that used to be okay, it went away for a period of time, and now it's back. So health reimbursement arrangements can be used to fund those types of accounts. As far as administrators, you do need an administrator for a health reimbursement arrangement. We do some of that here in our office, HRA administration, and some we don't. So we use third-party vendors for some of our accounts, and some we actually provide the administration ourselves, or we coach the employer on how to self-administer a health reimbursement arrangement as well. But that's, they're both government vehicles that exist, and they exist to allow employers and individuals to pay in a tax-advantaged way what would be considered predictable medical-related expenses. So they're alike, but they're different. HRAs are only funded by employers. HSAs can be funded by individuals or employers. HSAs, I mentioned, are bank-held, whereas HRAs are record-kept accounts. You can allow for rollovers of HRAs or not. HRAs are a very flexible tool to use for an employer group that wants to creatively structure their reimbursements to their employees, or get into things like subsidizing out-of-pocket maximums or deductibles, or providing a little layer of self-insurance within a fully insured contract. Those are so they're alike, but they're very different, and you'd use them differently as well. I hope I answered that question there.
Yes, no, thank you. I'm just checking. I think that was the last of the questions. So I'd like to sincerely thank you, Tom, for sharing your expertise on the health insurance roller coaster. If you have additional questions and are interested in getting in touch with Tom to discuss this topic, please feel free to reach out to me. I'm happy to put you in contact with him. As we wrap, I'd like to turn your attention to the next edition of 10KSB Talks. On Thursday, February 16th, we will welcome Daryl Fife, who is the founder of Digital Security Associates and Digital Forensic Solutions. Her topic is making sense of security, cost-effective computer security tips that anyone can understand. So please join us then. If you are interested in hosting a 10KSB Talk, please reach out to me. I'm currently filling up the calendar for 2017, and we'd love to have you. Thanks again, Tom, and thanks for all of you for joining us this morning. Until next time.
Thank you so much, Stephanie. We appreciate it.
Awesome.
All right, bye-bye.
Bye.